the property is located in the area with a higher rate of foreclosure or declining housing market. This may make the property a higher risk for the lender. Solution. Hello everyone. In this video, I will be sharing the top common 5 reasons banks or lender deny mortgage applications and providing practical solution you can implement right now to increase your chances of loan approval before even meeting with your loan agent or mortgage broker. This is from my experience of running my mortgage company then. So let's get started. If this is your first time visiting my channel, please subscribe and turn on the notification bell. My name is Korianne and I am a real estate investor since 2001. I make videos to share my real estate investing journey that got me to be financial independence after 8 years of investing in cash flow properties. Hope to inspire you to invest in cash flow real estate so you too can achieve your financial independence, build a legacy, and make an impact on the people around you. There are several reasons why a bank may deny a mortgage loan applications, but here are the top 5. Number 1 is poor credit history. Your credit score is an important factor that lenders consider when deciding whether to approve your mortgage loan applications. If you have a low credit score, a history of late payments, or high credit cost balance, collections, bankruptcies, or foreclosures or judgments, this negative mark can stay on your credit report for up to 7 years and can significantly lower your credit score. This can make you a higher risk borrower and lead to a loan deny. Credit score ranging from 300 to 850, with a higher score indicating better credit worthiness. The specific credit score range that lenders consider poor can vary depending on the lender criteria. Some lenders may consider a score below 620 or 640 as poor, while others may have more stringent requirements and consider a score below 680 as poor. Solutions. It's important to regularly check your credit report and address any errors or inaccuracy that may be impacting your score. You can also take steps to improve your credit score by paying bills on time, paying down debts, and limiting new credit applications. Number 2 is inefficient income or employment history. Lenders want to make sure that you have stable source of income that is sufficient to cover your mortgage payments. If you have a history of unstable employment or low income, this may lead to a loan deny. Let's say you recently graduated from college and have only been working at your first job for 6 months. You have a good credit score and have found a home you want to buy, but your income is relatively low since you are just starting out in your career. When you apply for a mortgage, the lender may see your short employment history and low income as a higher risk for the defaulting on the loan. In this case, the lender may deny your mortgage applications. First solution is to find a side job to increase your income for 2 years to show the lender that you are qualified for a mortgage. As a side benefit, having an additional source of income is a great way to increase your cash reserve for any emergency that happens to you as a new homeowner. Second solution is to buy a property within your income level so that you will not feel stressed with home ownership. Stay within your budget can be a good option for you. Start small and build up your reserve and savings. Third solution is to find trusted co-signer like your parents or family members with a stronger financial history to secure the loan with you. Even with a co-signer, you should stay within your affordable mortgage payment budget. Number 3, inadequate down payments. Lenders typically require borrowers to make a down payment of at least 3 to 20% of the home purchase price. If you don't have enough savings for the down payment, this may be a reason for the loan denied. An inadequate down payment refers to a situation where the borrower does not have enough money saved up to make the required down payment on the home purchase. The down payment amount can vary depending on the type of loan and the lender requirements, but is usually ranging from 3 to 20% of the purchase price. For example, if a home costs $300,000, a lender may require a down payment of 10% or $30,000. If a borrower does not have enough money saved up to make the required down payment, this can be seen as a higher risk for the lender. In this case, the lender may deny the mortgage loan applications. First solution, if you have an adequate cash in your retirement account, you can borrow money from your retirement account for a down payment and then repay it back with an interest. Second solution, start making a saving goal for a house down payment. You may need to adjust your spending to cut unnecessary expenses to increase your savings rate. Third solution is partner with your siblings who are interested in home ownership. With co-ownership, your co-owner can contribute their share of the down payments. Having a larger down payment can have several benefits, include a lower monthly mortgage payments and even a lower interest rate. Number 4 issue is property issues. This includes property condition. Lender will want to ensure that the property is in good conditions and does not have any major defects or issue that could affect the value or livability of the home. If the property requires significant repairs or renovations, the lender may be hesitant to approve the loan. Appraised value. The appraised value of the property is the estimated value of the home based on the independent appraisal conducted by professional appraiser. If the appraised value of the home is significantly lower than the purchase price, this could be a reason for the lender to deny the loan. Property types. Some lenders may be hesitant to lend on the certain types of property such as condominiums, co-ops, or mobile homes. These properties may be seen as a higher risk due to the factors such as share ownership or the difficulty of reselling the properties. Location. The location of property can also be impacting the lender decision to approve the loan. If the property is located in the area with a higher rate of foreclosure or declining housing market, this may make the property a higher risk for the lender. Solution. You need to work with a knowledgeable real estate agent who can assist you to avoid some of the pitfalls previously discussed. They have access to this data and can advise the pros and cons of each property before you enter into a purchase contract agreement. Number 5 is debt to income ratio, which is DTI. DTI ratio is the amount of debts you have compared to your income. Lenders use this ratio to determine your likely ability to make mortgage payments. If your DTI is too high, this can lead to a loan denial. DTI ratio is a financial metric that compares your monthly debt payments to your gross monthly income. To calculate your DTI ratio, add up all your monthly debt payments, including your mortgage or rent payments, car loans, credit card payments, student loans, and any other debt payment you have. Then divide that total by your gross monthly income before tax and any other deductions. The resulting percentage is called DTI ratio. For example, If your total monthly debt payments are about $1,500 and your gross monthly income is about $5,000, your DTI ratio is about 30%. Lenders typically use your DTI ratio as a way to assess your ability to manage monthly payments on a new loan, such as mortgage. Generally, a DTI ratio of 36 or less is considered healthy, meaning that you have enough income to cover your monthly debt payments and still have enough money left over for other expenses. A DTI ratio above 36 may make it more difficult to obtain a loan, as lender may see you as a higher risk borrower who may struggle to make monthly payments. First solution is pay off some high monthly payments balance to lower your total monthly debt payments. This will lower your DTI. Again, lower your DTI is better. Second solution, to increase your gross income, which means lower your debt to income ratio. Third solution is buy a home within your means, which means that your income support the qualified mortgage payments. It's important to note that each lender has its own specific criteria for mortgage approvals. So it's a good idea to consult with a lender or mortgage broker to understand what factors they consider when evaluating the loan applications. This professional can guide you on what needs to improve prior to applying for the mortgage. I hope you enjoyed this video, and if you do, then click the thumb up to support my channel and also share it with others. Thank you for doing that. Share with me in the comment below what your experience is in securing a mortgage loan approval. Thank you so much for watching. Let's learn, invest, and make an impact. Ciao!
Yay! Good job, Matthew! Higher, honey! Open your eyes, honey!
Okay, ready? Tommy, jump. Get ready.